Hi, everybody. This is Garrett Baldwin. I hope you're having a great day. This is the famous update to what has become known as the wave speech. This is a full recap of pretty much all of the academic work that I have done over the years. And what is so essential about this truly gives you a real understanding of how the financial system actually works, right? The entire focus here is to give you the worldview that I have and help you understand how the markets really work. I have deep expertise in investment upside. I focus on this alternative worldview in three major trends: liquidity, momentum, and insider buying. This is about exploiting the financial system's design. And as you're going to see, I'm going to show you the number one stock to trade based on what you can't unsee in this environment, plus 10 more tickers related to this. My name is Garrett Baldwin. I have a master's degree in economic security from Johns Hopkins University, master's degree in agricultural economics from Purdue, an MBA in finance from Indiana, and I studied cross-border capital at Harvard Business School. My primary focus is in monetary policy and global liquidity. At the micro level, I focus on company catalysts and value drivers of equities. I am an energy and commodity economist by trade with a heavy emphasis on supply chains, and I focus on major anomalies in the market, primarily the ones that you can't unsee, right? Things like insider buying, reversion momentum, and value where there is value. Unfortunately, in this market, we have seen beaten up equities down in the Russell 2000, things trading well below their book because of the financialization in the economy. I will talk to you about that as we go. So, what are we doing today? I want to point this out. This is my worldview. And I am very, very tired of a media narrative that wraps itself around things like earnings and things like the Fed meetings and all of these things that really honestly don't actually share reality in the post 2008 and especially post 2020 financialized economy. Right now, up front, I'm going to tell you, I'm citing all of my work. I am an academic, so I think it's very, very important to say thank you to the people who came before you and also to show you that this presentation is on the backs of years and years and years of work at the academic level in the real lab of the financial markets. Capital Wars by Michael Howe is a primary influence and a major shaper of this presentation, in addition to the work of J.D. Henning's multiple discriminant analysis of the price momentum anomaly and reversal event signals, plus dual momentum investing by Gary Antonacci, trading stocks by the numbers by Grant Henning, profitable momentum trading strategies for individuals by Brian Fultese, and my Thanksgiving dinners with Tim Melvin, my father-in-law, over the last 12 years. So let's get into this, right? My focus is to get you to think differently about the markets. And my focus is on three major factors that I promise you will not unsee after this presentation. But before we begin, I want to remind you, keep your hands and feet inside the ride. The number one rule of all of this, the most important thing that you can remember, is that a system is set up to create the results it achieves. Attributing this to W. Edwards Deming, my point is when something is designed to achieve certain things, that's the purpose of it. Every result reveals the true design. So the results of the financial system reveal what the financial system is set up to do at the Federal Reserve level, at the shadow banking level, at the institutional level, and ultimately at the policy level. Following will reveal these outcomes of the global financial systems design. So the very first thing, I know this is an intimidating term, but it's very simple. The concept of global liquidity. Global liquidity is just money. It's all of the available cash and credit in the financial system, influencing asset prices and global economic activity. That's it. It's money sloshing around in the world, and measured by cross-border capital, they take into influence the shadow banking system. All money beyond what we know as the M1 or the M2. This is every dollar out there, the cash in your couch, the money in the computers, every single drop. Now, why does this matter? Because as Hal points out, and this chart from Ainsley Wealth in Australia points out, capital moves in cycles, liquidity cycles. This is important. Since we came off the gold standard, the influence of fiat currency, paper printed currency, having no anchor to anything, ebbs and flows in terms of boom and bust. Everything the Federal Reserve was designed to do in 1913, prevent major crisis, we come to find that their policies are actually the drivers of the boom and bust cycles that we have seen since the early 1970s. That includes the global commodity boom in the early 1970s, the expansion of fiscal and monetary policy in the 70s to meet the demands of the Vietnam War, the expanding government size of the government, the ongoing expansion of the welfare state. We saw a big boom in the post early Reagan years. We saw the Reaganomics boom in the 1980s. We saw a globalization boom in the early 1990s. But along the way, we have had these liquidity shocks, these events that lead to pronounced downturns in global markets, because at the end of the day, as Hal notes, and so does Stanley Druckenmiller, it is liquidity, it is capital, it is the amount of money in the system that allows equities prices to rise. This is very simple. So if we look at the boom and bust cycles post 2008, we had a QE boom created by cheap capital, lots of injections through quantitative easing, and that ultimately led to refinancing crises that we saw in 2011 in the Eurozone. We had another QE, another era of very cheap money, and then we had a repo crisis here in 2018. What did we do? Turned around and pumped a ton of money into the system during COVID. What did that create? Inflation, which required tightening by the Federal Reserve and helped contribute to the regional banking crisis in 2023. Right now, the cycle we are in, we are still ascending in the current cycle. But what has happened since 2008 and this ongoing monetary expansion has pointed out that there's something broken from what most of us have learned over our period of education, or getting our CMTs, or getting our CFAs, or anything that is tied to the market. We are taught antiquated ways to view the market. Price to earnings doesn't matter. Liquidity theory offers a rational explanation for market spikes and crashes since the great financial crisis. Capital is driven primarily through the shadow banking system, according to Posner. If you haven't heard of Zoltan Posner, I highly recommend you read any of his works post 2008. Really had pointed out that the 2008 crisis had originated in the shadow banking system. And I'll explain what the shadow banking system is momentarily. But again, I recommend you also follow Michael Howe, Merling at Columbia University, and Adrian Shin at the BIS and Princeton, who focus on the shadow banking system. The shadow banking system consists of hedge funds. It consists of private equity. It consists of banks that aren't regulated, that are able to take U.S. treasuries, go out and either leverage that or borrow on the back of these treasuries, and then create credit and leverage in the financial system. And as we'll see, when that stuff unwinds and when it cracks, that is what leads to our short-term panics. And that is why we have had four sigma events, 1 in 63-year events, transpire in the last 4 years, and 5 in the last 6 years. Liquidity explains why QT efforts didn't lead to a downturn in the equity markets in 2023 and 2024. And it defies so many bearish crash calls that happen not only on Wall Street, but also in the financial publishing industry in which I operate. The central banking system's design is to provide support to global liquidity and prevent deflationary crisis globally. That is very critical. The central banks fear deflation more than they fear inflation. Now, when we talk about shadow banking, we discuss repo market leverage and asset purchases. What happens is hedge funds borrow via repo. They use the collateral to reinvest in stocks, bonds, and commodities. And you'll hear about this with treasury bills. They are a premium collateral in repo markets. This is very important, is what is happening right now and why our markets have been so strong the last few years. The U.S. Treasury market has issued roughly 50 to 60% of new issuance of debt is in short-term bills, things that expire within a year. And as a result of that, that money ends up in the repo market. That money is leveraged. And then that is how you end up with these basis trades, these wild trades that create massive amounts of leverage. And in the event that we have a crisis, well, the unwind on the 10-year becomes a problem, but the short-term T-bills are very highly liquid. And that is what a lot of lenders want, because they are premium collateral. Securitization, credit expansion, buybacks, and M&A, this is all part of the ongoing financialization of our financial system. Loans are securitized into CLOs, ABS free up capital. This allows corporate buybacks, it expands private equity, and enhances M&A. Again, this is not about the underlying economy. This is just about money and the allocations that the incentives that exist and how things move very, very quickly to maximize returns on this fiat environment of explosion in liquidity, and not really focusing on the short terms of how do we enhance our business, how do we build our institution over time. There's far more incentive to speculate on leveraged ETFs than there is to build a factory and wait 10 years for the payback period. And to prove this, there's now securitized loans in the super yacht industry. This is where we are. Credit Suisse has securitized a portfolio of super yacht and private jet loans. Well, do you need any more proof that the United States and Switzerland doesn't create anything? This all goes back to the weakness in our currency in terms of us as the global reserve currency, the fact that our currency is overvalued, the fact that that is a tax on manufacturers. We don't build things in America. We effectively just move money around constantly, and we look to enhance and make big returns off things like securitized yacht loans instead of building a factory, putting people to work, and waiting years for the return. Derivatives and synthetic liquidity, TRS and CDS, credit default swaps, they amplify leverage. They drive speculative debt trading. They influence stock and bond spreads. Private credit and leverage loans, they enhance corporate risk. Cheap credit fuels leverage buyouts, speculative expansions, and buybacks. Again, some of you might be saying to me, what the hell are you talking about? Well, that's the entire point. All of the capital that it is in the system, all the new money that is made is going into this. It's not going into creating a new business in Ohio. It's not going into creating a new mine out in Montana. It's sloshing around and moving into these financialized assets that have exploded since the 1990s after policy change that really freed up so much of this. This is Brooksley Born's warning at the CFTC back in the 1990s before people like Larry Summers ran her out of town. The end result has been more leverage in the markets, higher demand for equities and bonds. Credit expansion supports risky borrowing, which creates more corporate risk-taking, and financial engineering amplifies speculation, and that is in the hedge fund, private equity, and institutions piling into risk assets, and that includes equities. Now, I keep saying the term liquidity. What does that even mean? Well, I go back to Howe's definition. This is all of the money in the system. And liquidity equals savings plus changes in financial liabilities. And that equals investment and changes in financial assets. And what I like about this is that this is an equation. And this is a major theme for me. I like equations. I like being able to measure whether or not the rocket can get into space. I like physics because there are laws built around it. Economics focuses on models. So does a lot of social sciences. They go out and they try to find the answer first, and then they gather the information to try to prove their point. But there's no equation for social sciences. There's no way to consistently replicate it. There is no E equals MC squared for economics. So we are looking for money flows, and how does that by analyzing this total figure and produces this. This is the causal relationship between Howe's measurement of global liquidity and the MSCI Global Index, which is all equities globally. Global liquidity in June 2025 set around $190 trillion. It's up $12.5 trillion since January 2023. And that is why the equity markets have moved higher, even though the central bank has been engaged in quantitative tightening. Right? The idea that they are letting things roll off their balance sheet and keeping interest rates higher doesn't matter because liquidity continues to expand and that money finds its way into risk assets. This all goes back to COVID. And I will try to explain this at a very academic level, but this comic, Mo Amer, was on Netflix, and he was pointing out that in 2020, April 2020, everybody was at home. And yet the stock market was rocketing. He noted that they shut the economy down, that everyone was losing their job, that they sent all these checks to Americans. And yet, despite the fact that the economy, which is supposed to be the great engine of, right, the stock market is supposed to be the great predictor of the engine that is the economy was sluggish yet the stock market was rocking higher. Well, why was that? Very simple. The massive expansion in liquidity, the massive amount of money pumped into the system. This is not a coincidence. So while we have all this talk about earnings reports and we have this talk about, well, what is NVIDIA going to do next and how is that going to enhance the AI system? None of that really is as important as the core driver, which is liquidity. And ultimately, that is what leads to massive amounts of investment up at the top in the S&P 500, significant amount of passive investments, ETFs that exist. Again, the great financialization of the U.S. markets. I want to point something out very, very simply because it speaks to the insanity of our financial system. What I'm going to just simply show you right now is the number of stocks on the S&P 500. Or forgive me, in the broader market. I'm looking at FinViz. There are 5,499 stocks that I can look at and trade today. There are 4,264 ETFs. There is almost an ETF for every stock that is publicly traded. What does that tell you about this economy? Highly financialized, highly passive, and highly driven by capital and liquidity and incentives. So this is why post-2022, when the markets were struggling in 2022 because of higher interest rates and we had what was called the GILT crisis, the markets took off. Everyone was bearish heading into 2023. There were multiple banks that had projected a move to 3,250 on the S&P 500 when it was sitting around 3,800. But Howe came along and said, no, 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 no. Pay very close attention, not to what the central bank is doing, is saying, and not what the Treasury Department is saying. Pay attention to what they are doing. And at that time, they started to engage in various levels of quantitative support, according to Howe. And this is what is so important. This influx of cheap capital via moving T-bills by the Treasury, short duration, amplified credit, amplified risk, amplified leverage in the financial system. That helped fuel an expansion of returns on the S&P 500 and other equity markets. So this area here that you see, the reddish color, that is not yield curve control, something that is done to help suppress interest rates, right? That they didn't call it yield curve control. They just called it something else. And they were injecting ample amounts of T-bills into the system when they were refinancing debt, and that helped amplify broader market returns. In addition to that, the Federal Reserve was stepping in. No, they were not calling it quantitative easing when they injected money into the banking system during the Silicon Valley banking crisis. They didn't call it QE, but here's the point. Something that is aiming to achieve the same results as QE, that's all that matters. If the goal is to achieve the same outcome as QE, but just call it something different or engage in a mechanism that leads to the same results, it doesn't matter. It was a policy shift, and those policy shifts had helped contribute to the expansion and the returns of the S&P 500 in 2023 and 2024. Now, as you could see, that liquidity starts to drain into 2025, which helped explain the downturn that we saw from February into March. Now, this is very important because something else happened in late March that fueled a much bigger downturn in the markets. But what Howe is now saying is that Scott Bessent has helped adopt the exact same short-term strategy because the Federal Reserve the Treasury is bound to do that. With interest rates very high, trying to sell debt over the long term, 10-year bonds, 20-year bonds, 30-year bonds, not only does that drain capital from the system, but we're also going to have to pay higher interest rates resultantly. So maintain the exact same strategy, the non-yield curve control, the short-term T-bill strategy is expected to continue now, according to Howe, into 2026. And that may lengthen the current liquidity cycle that Howe has predicted. And resultantly, what that leads to is expansion and continued support of the equity markets, in addition to probably no significant sustainable downturn over a period of time. We just had a sharp market downturn transpire in April, yet there was a policy shift and there has been accommodation from both the Federal Reserve and the Treasury Department since then. Scott Bessent is driving the bus, and there is a possibility that he will become the next Fed chair. And if that is the case, look for more accommodation heading through at least the election next year. Why did these short-term bills that we talked about juice markets? Well, the T-bills function like cash. More bills mean more cash-like assets in circulation. T-bills serve as a premium as repo collateral. They enable more lending through financial markets. Short maturities give holders flexibility to quickly redeploy funds. And liquidity equals assets divided by duration. Shorter duration mathematically creates more liquidity, right? Shorter duration ensures that more capital stays in the system. Longer term locks it up. Dealers finance T-bills through repos rather than asset sales. That preserves liquidity and capital in the system. So I want you to look at this chart because, once again, this is the S&P 500 return over the last 5 years since COVID. You see that sharp downturn to start in 2020, and then the move higher, and then the sell-off, the liquidity drain in 2022, and then the expansion of the market over the last 2 years as the Federal Reserve and as the Treasury Department provided support to the system itself. Well, the Chicago National Index tracks things like jobs, production, and spending. And in here, these lines here, one is risk, one is credit, one is leverage. So when capital comes into the system and there is stronger economic out expectations, you have an expansion in risk, credit, and leverage, right? In a positive territory, that is bad for the economy. That is typically where the Fed has to step in. But when there is this expansion, this is showing all systems go. Well, the United States market, the S&P 500, is supposed to reflect or at least be predictive of economic outcomes over the next 6 to 12 months. But fascinating enough, it actually seems to be tracking liquidity flows into the system itself, the leverage, the risk, and the credit expansion. The market is supposed to predict growth over the next 6 to 12 months. It is reacting to liquidity flows in real time. And since 2020, stock prices have stopped caring about things like profit and growth, and we're really focusing on these 5 things. Fed money printing, whether they're going to print or not, the kind of debt that the Treasury is issuing, whether it's short-term partying or a long-term hangover, how much collateral Wall Street has to gamble with, what momentum traders are chasing, whatever is fast and popular, AI, pick any buzzword you want, and liquidity events, which we have had many of those, and I'll break a lot of those down relatively soon when the financial system is under stress. And then ultimately what policy accommodates and prevents that stress from leading to something even more significant. Howe has written about this. I highly encourage people read Capital Wars, the book, and then also follow him on Substack. These are the cycles that he has followed, and this is the move through about early 2025. He's predicting an continued expansion in this current liquidity cycle, and what you will see is that where we bottom out in most of these, this is typically where we have seen major downturn events for the equity markets as liquidity drains and pulls capital away from risk assets. So the expectation, I believe, according to Howe most recently, an expansion of this cycle into 2026, and then we have to start to worry and look to the other side. Now, this is where it gets exciting, right? 6 out of every 7 new dollars that Howe has said is used to refinance existing debt, which means the entire financial system today is not about growth or creating anything new. It's about refinancing existing debt. Only $1 of every new $7 actually finances growth. So new liquidity, which is fueled by collateral quality and monetary inflation, is what drives risk and equities, right? And based on the cycles, the market bottomed out in October 2022. This is now going to be changed to probably mid 2026 and possibly even the election. We saw that bottom out in October 2022 with the GILT crisis and the MBS crisis, also the ongoing crisis that we had with Silicon Valley Bank. We saw policy shifts. And then the last point is global debt and global liquidity move together. And this is important. When global liquidity is more than global debt, that leads to more inflation. And when global liquidity is below the amount of debt, that can lead to deflation spasms, which creates a liquidity event, which creates a short-term crisis, which requires the Federal Reserve or another central bank to step in and bail out the system. And that is all about understanding the pattern that comes next. You don't have to understand liquidity or liquidity events or anything like that. You simply have to be able to see the pattern. And I'm going to walk you through that as we move into Momentum and Insiders. The result of all of this is that you pay attention to what the Federal Reserve is doing with interest rates. They're literally making it up along the way. They're always playing Calvin ball. And that it goes back to Calvin and Hobbes. The rules are made up, the money isn't real, and the reality is we all work for something that another man like Jerome Powell or Scott Bessent can effectively print. Our dollar is a mechanism of refinancing globally. And we as Americans and as people who accept the dollar as the way that we are compensated for our time, we have to recognize that we're kind of playing a shell game with that currency, and we better put that money to work in order to preserve the value of our time and our energy and our work. Everyone has a role in this financial system. Central banks are responsible for stabilizing debt systems. Expansion of private sector balance sheets are what enable debt growth. Private credit has massively amplified new liquidity in the system right now. You've probably heard a lot about private credit. We can and we should expect more monetization by central banks, with the Fed increasing its balance sheet to probably 10 trillion or more come the bottom of the next liquidity crisis. The Fed is going to have to be the buyer of last resort. They're going to have to try to monetize interest rates. They're going to have to continue to try to save the system because, again, a system is ultimately judged by its results. It is doing what it is designed to do. So quantitative easing, QE forever, will continue. They would rather let asset prices rise than let them crash. Central banks are deathly afraid of debt deflation spirals, and we have a playbook for this. But first, market momentum. So this is all built on a bell curve. This goes back to J.D. Henning. J.D. Henning wrote a phenomenal dissertation in 2016 explaining the 7 stages of price stock movements. And as you could see right here, there are 7 different ways that a stock can move. It can move in a negative momentum reversal, which is stage 1, negative momentum acceleration, negative momentum control. Okay, don't worry about any of that. Focus on 2 and 6, the stocks that are breaking down in an accelerating way and the stocks that are going up in an accelerating way. Well, what he uncovered and what he continues to advocate is that all you need to do is track those stocks. Track the stocks that are positively accelerating, track the stocks that are negatively accelerating. And when you have more stocks in stage 6 than stage 2, based on the coefficient analysis, it's a buy. The markets are in green condition. When you have a tie, right, 8-8, you are yellow. This is where you want to start to hedge. And when we have a negative move, particularly in the S&P 500, that is where it is time to either start to raise cash, hedge your positions, or move away. Now, this is important. When there are no stocks breaking down and we are in this kind of blowout top, that typically aligns with a market top. When there are no stocks breaking out, that is where we are typically at a liquidity bottom or a short-term bottom that will require some level of policy shift to help get the market off the ground. And we've seen this over and over and over again. Now, resultantly, what we've been able to do is replicate this and enhance it using a variety of different technicals. We use the MACD and the ADX to measure rate of change. This helps us time market downturns. We confirm with leveraged ETNs and leveraged ETFs. We focus on technical support. We look at moving averages. We focus on the outlying prices on FinViz and bar chart. We align with other primary trends, things that we've discussed, liquidity and insiders. And as I've said, a lot of this is built on the back of the work of J.D. Henning's work, Grant Henning's work, and others like William O'Neill, Joel Greenblatt, and Fama and French. And the emphasis on negative and positive acceleration in price movements to reach a signal and give us confidence each day. This has been the result of knowing when to get in and when to get out, when to hedge, when to short, when to turn around, and when to buy. Now, this is just on momentum. I'm not talking about insider bottoms. I'm not talking about if and when there is a big policy shift. But this is what we have been doing live since 2022. And as you can see, if you are able to adjust, you will come to find it's never at the exact top. It's never at the top. There's always a little bit of selling. There's always a little bit of a short squeeze into another move, and then funds dump their stocks right back into the face of that strength. And that is what leaves so many retail investors holding the bag. As a result of this, we've been doing this since 2022. We've avoided all of these crises. We've avoided the 2022 rate hike crisis. We avoided the largest hedge fund sell-off in 15 years. We were ahead of this on the GILT crisis. And the thing about this, when this signal goes negative, we don't know why it is. We don't typically find out for a couple of weeks. In fact, when it came to the Silicon Valley banking crisis, this had gone negative on March 7th, and we didn't know why. And 4.5 days later, Silicon Valley Bank was gone. This went negative on August 1st, 2024, and 4 days later, we had the largest sell-off in Japanese stocks since 1987. And by the way, this went negative on February 21st of this year, and I wrote on that date the fact that this was the exact date, February 21, that the very first time that I tested this was February 21, 2020, during the COVID sell-off. What's really nice about this statistical analysis is that you can do it with any sector. Every sector has a different coefficient, a different number of stocks that you can watch. And ultimately, what you could see is that a lot of this will align with a variety of different technicals, considering the exponential moving average of the 20-day moving average or the 50-day moving average of various sectors. But it gives us a number to keep watching, because as breakdowns continue and we start to see the sector weakening, we want to know if this is going to be a sustainable sell-off or if this is a larger kind of effort just to kind of reset and then retest a few technicals and then lead to more buying and rotation at any given moment. This was our sector move where we were on March 11th of this year, and I'm going to walk you through what happened next. So we use other signals for confirmation. Like, we may get a negative figure in the short term, but we want to pay attention to leverage in the system. The triple Qs, which is the ProShares Ultra Pro QQQ, this is a leveraged ETF around the NASDAQ. Well, what we see here is when the leverage starts to drain, this can break down pretty quick. You're looking at the QQQ breakdown that transpired in February, breaking under its 20-day EMA and its 50-day EMA. Nothing good tends to happen for the tech sector when it is under its 20 and 50-day EMA. So there is an enhancement here. And then as you can see, we've moved above that EMA, 20-day EMA in around mid to late April. That coincided with a positive momentum in the broader market. When we got back above that 50-day moving average, that is where a lot of risk on behavior reemerged in the markets, particularly for semiconductors. We have a short-term signal, and this is our short-term signal from June 18th, 2025, the day that I'm shooting this. And right now, we have more stocks breaking down than we have breaking out. But the bulk of this for the S&P 500 is happening in the lower end of the S&P 500. It's not happening in the FANG stocks. It's not happening with the NVIDIAs and the Amazons, where there's a lot of passive investment and tons of capital is locked up in ETFs. So we have to look for another confirmation. And the FNGD, which is a leveraged inverse ETN, I don't know, you don't even need to know what this does. Just recognize that when this breaks above its 20 and its 50-day moving average, nothing good happens. What you're looking at on the left side of the screen is the onset of the Nikkei crisis. Money was already moving out of the market in July of 2024. But then once we broke that 50-day, that's where the problems really accelerated. And as you'll see, and I'll note relatively soon, What happened in order to stabilize this market and allow this market to start to recover from the Nikkei? Same thing that happened in April, a major policy shift. Our momentum signal went negative on February 21st. It was confirmed by the move on the FNGD on the 24th. And then you see that little pink line. I'm going to explain momentarily what that was. We had a little bit of a squeeze, and then ultimately we sold off again as the FNGD broke above its 20 and its 50-day moving averages. Again, nothing happens good when you're above those levels. That is COVID in 2020. So the selling really began in late February, yet we did not know that we were going to be shutting down until around mid-March. Money was already exiting. Money had already flowed out. And the worst started to transpire when the shutdown occurred. However, you could see institutional flows and leverage and risk leaving as it broke its 20-day, cracked above that 50-day, got a little bit of a squeeze, and then ultimately moved higher on the FNGD. This is a warning signal, much like the volatility index is a warning signal as well. Always watch the FNGD for confirmation. This is 2022. This is the GILT crisis. We went negative right around the period when Jerome Powell spoke at Jackson Hole. This sell-off right here started in April. Well, this coincided with the biggest hedge fund sell-off in 15 years. Lot of risk-off behavior that transpired. This year was very, very shaky for investors. We managed it. We had tons and tons of moves, positive and negative momentum, tons of buying opportunities followed by sell-offs. You follow the FNGD, and if you are an active trader, you move to cash or you hedge when it breaks these levels. And once again, just paying very close attention, this is the GILT crisis, and this is the Silicon Valley banking crisis that transpired. Forgive me, no, this is December. This is the Silicon Valley banking crisis, which wasn't was pretty short-lived on the FNGD. But remember, this was a period of time where it was a crisis, but this was so heavily focused on the banking sector that the FNGD did not necessarily react to it. So when we are looking for bigger, broader sell-offs that are tied to the S&P 500 and tied specifically to the FANGs, this is our first indicator, but we have to pay attention to our overall indicator, which was telling us that we were heading negative, and we started to have that move in March as we broke above that 20-day moving average. Using leverage to your advantage, every single one of these ETFs, bullish leveraged ETFs, you could pay very close attention to, and you can just trade them individually. If they are above their 50 and their 20-day moving averages, they become buys. They become speculative up to the upside. You let them go on the other side. And then, again, when things are breaking down for the S&P 500 or technology stocks, turn over and look at the SPXS, the TECS, the SOXS, the FAZ, and the FNGD. The last core thing, insider buying, and this is very important, right? The insider buying is the ultimate contrarian signal. So this is the first chart that I check each day. Insider buying, dollar for dollar, buying to selling amount. This is the 5-day moving average. High buying signals traditionally align with short-term bottoms in the equity market. And if we look at this right now, you could see that what happened in late December of 2024. There was a big downturn, a lot of tax harvesting, and a lot of movement around triple witching around the third Friday of December. Well, the insiders called the bottom of that period. Lots of insider buying. That signaled a short-term bottom. And this is important. Low insider buying signals tend to signal short-term tops and earnings season blackouts. But this is the most important chart in finance. Insiders collectively called the bottom of every short-term crisis dating back to 2008. This spike in buying to selling, this blue line, buying to selling, 5-day moving average, has called the bottom of pretty much every major crisis that we have had. Here we go. This is Lehman Brothers. This is the beginning of QE in 2009. This is the August 2011 European banking crisis. This is the Chinese crisis in 2016. This is the repo market spasms that we had in 2018. This is COVID. This is the GILT crisis back here. This is the Silicon Valley banking crisis and the yield surge that we saw in October of 2023. Each event has accompanied a major shift in fiscal or monetary policy, be it quantitative easing by the Fed or some shift in policy by the ECB, as we saw in 2011. And as a result, every event has accompanied the shift that has recharged global liquidity and led equity prices higher. Even in down market cycles, pay very close attention to rallies and dumps, and most have featured oversold conditions on the relative strength index, which is a 30 or less, or the money flow index of 20 or less. The relative strength index is a price momentum oscillator. The money flow follows price and volume. Price and volume. So it's very important for us to track this. Now, in this chart, I have the MACD up accidentally, but you can see there's also a strong relationship between the MACD and the bottoms in the RSI. And the RSI, MACD, ADX, and the money flow all work together. This is very important. Stanley Druckenmiller noted in 2018 that algorithms are buying in the third standard deviation of oversold conditions. We're seeing it more and more in the fourth deviation as well. And we've seen strong recoveries on policy moves. Oversold patterns of RSI and money flow at 30 and 20 simultaneously have been periods for market reversion. And we've seen this in the British gilt crisis with the Fed shifting on its mortgage-backed security policies. In March 2023, the regional banking crisis, we saw liquidity support through the bank lending programs. In October 2023, Treasury yields surged. Yellen helped respond with selling more T-bills. In April 2024, we saw a money market tax sell-off. The Treasury responded again by draining the Treasury general account. In August 2024, we saw the Japan crisis, the Bank of Japan issuing a calm statement. And on April 8th, insider buying, we saw cancellation of Liberation Day in oversold territory. And this is April 8th of this year. This is where so many people are saying, wait a minute, what happened? How did the market recover as quickly as it did? Well, we saw very oversold conditions on RSI on the daily chart. Money flow index was down around 30. Look at the insider buying spike that transpired that day. All at the same time, record buying levels on the TQQQ, which is the leveraged ETF of the NASDAQ. Well, why does that matter? Because the market just absolutely took off after that, right? This is where we're at the bottom. This is where the insider buying spikes. This is where the policy changes on Liberation Day, and the markets were off to the races for the end of the year. This is what I did. And I walked everyone through this because I've seen this so many times now since 2020. On February 20th, I sent an article out and I said, it's yellow. I don't think it's anything. I don't know what's happening yet. But the next day we went red. We saw a move under the 20-day moving average. We saw a surge in 5% losers. It said that money was going somewhere. And once again, we got a confirmation here. Critical line to watch, as I said on February 21st, a move on the FNGD above its 50-day moving average. Well, we got that. Here's where it gets interesting. As I said earlier, when it comes to the number of stocks that are breaking out and breaking down, when we have no buying pressure, right, on that equation that we were talking about, no buying pressure, no stocks breaking out, that typically signals a bottom. But if there isn't a spike in insider buying and there isn't a shift in policy, it is a short-term bottom. And typically what we have seen is a squeeze as a result, a short-term squeeze, because funds don't want to keep selling into an environment where nobody's buying. So the amount of buying slows down and a little bit of short covering starts and people start to cover their positions. What ultimately that does is it sucks everyone back into the market. And I said on March 12th, a squeeze is coming. And sure enough, here you are looking back here at this chart. This is where I said there would be a squeeze. There was no buying pressure in the market. And we squeezed back above our 20-day EMA for the SPY. And then suddenly on March 26th, the pressure rebuilt. The FNGD broke back above its 20 and its 50-day moving average, and the rest was history. If it breaks under the 20-day moving average, I said on the S&P 500, we have the FNGD, if it breaks above its 20-day moving average, we have a problem. We had a problem. That was a rug pull, March 27th. I said I don't feel good about this on March 27th. And I didn't feel good about it because the market absolutely cratered from there. This is the pattern that you will see in a very significant downturn in the market. You will see a sell-off, you will see no buying pressure, and you will see a squeeze. If there is not a policy change here and there is not a spike in insider buying, be very, very wary about any short-term pop above these moving averages, because the second it drops under that moving average again, we have seen very sharp downturns. It happened during COVID. It happened during the Nikkei crash. It happened during the Silicon Valley banking crisis. It happened during the GILT crisis in 2022. So now what happens is you start to change your policy focus. Now you start to think about, when is the optimal time to buy? Well, on April 7th, everyone was talking about the Great Depression. Everyone was an expert in the Great Depression. Oh my gosh, we're going to have another Great Depression. Everyone. And then 2 days later, we saw insiders buy at the highest amount in the insider buying to selling equation since December. And we saw a policy change by Trump, and the markets took off. Wait until everyone is screaming about blood in the streets. Wait until Jim Cramer is crying on air, as he did back during the GILT crisis when Meta stock crashed. He did not know that this was a liquidity cycle event. And most people don't realize that when it came to this period of time, the real problem was the bond market. The real problem were concerns about interest rates and what would come next. And when momentum came back, as I said on April 23rd, it had coincided with a move above the FNGB. This is the FANG sector's triple leveraged ETN, debt derivatives in the FANG stocks above its 20-day moving average. Coincided with the positive equation that we had right around that time as well. Money was flowing back in. The FNGD broke its 20, and the market has not slowed down since. This is a boxing match mixed with chess against the market. And if you follow this equation and you follow this setup, it has basically been the way the markets have behaved since COVID, largely because liquidity is so much driving the bus, and policy is so critical in terms of understanding the global financial system and how ongoing refinancing is necessary and will continue as long as it can until it finally breaks. So this was what happened. A negative signal. We had an FNGD crossover, and we had a multiple 2% days. This happened back in February 21st. We saw the sell-off. We pushed to oversold. We then ultimately saw that squeeze that I talked about. We had another sell-off on the 26th because there was no policy shift, no amount of insider buying. Then we had the policy change. That happened around April 8th, April 9th. Trump came out on Truth Social and said, seems like a great time to buy. And then everybody did. All the insiders did. Huge uptick on the dollar aggregate insider buying to selling ratio. We had a short-term recovery over a period of 14 days, and then positive momentum returning to the market on April 23rd, April 24th, and we haven't stopped since. This is how the market works. It's liquidity that moves markets, and it's the refinancing system. And this goes back to Stanley Druckenmiller. And we're no longer the Republic, right? We are the Capital Wave Report. And we are a different type of focus, right? So right now, as we say, all roads point to more monetary inflation and liquidity expansion, MILE. So what is the playbook? Well, gold and metals, copper and China. Once again, if we have quantitative easing, that benefits our banks. If China has quantitative easing, that benefits copper. We are a financialized economy. They are a manufacturing economy. Keep your focus in energy, electricity, and midstream stocks. Focus on blue chip stocks with high F scores and strong buybacks. Look for things that kick off cash flow. Have some exposure to Bitcoin when liquidity is expanding. But when liquidity weakens, Bitcoin will have its next winter. And be active in the markets. Look for that one stock that we're always looking for. Now, the funny thing about this is that the stock to always watch and the stock to trade when there's a policy shift is a boring insurance stock. And I ask you the same question every time. What company benefits immensely from excess liquidity, lower default risk in the global system? It is the same company that was the third largest bailout in American history. It's AIG. AIG, at every one of these major downturns that we have seen in the market, the 2011 crisis in Europe, the 2015 crisis and 2016 crisis in China, the repo crisis in the United States in 18, the COVID crisis in 20, the GILT crisis in 2022, the bond issues in 2023. When there are policy changes and policy shifts and insider buying picks up and we come out of oversold territory and we're looking for strength and momentum, AIG stock takes off. Why? Because default risk has been delayed. When you pump more liquidity and become more accommodative into the system, the risk of default declines. We had two negative events that transpired last year. We had the April sell-off that was tied to the money markets, and then we also had the gilt crisis. Well, in both cases, there was a policy shift. We had Yellen become more accommodative in 2024 using short-term T-bills, and then we had the policy calm statement from the Bank of Japan. And what happened? AIG took off again. Oh, and by the way, it just happened again in April. We see here that AIG did actually okay to start the year into March and April. And this points out that move that happened in the market from February and March was really not tied to the trade crisis. It was tied to excess liquidity draining, but a lot of capital shifting to Europe and other markets around the world. If you look at the EWG, the Germany stock market, you look at the Poland stock market, they all did very well to start the year. But it was when AIG cracked under its 20 and its 50-day moving averages in early April that there were deep concerns about default and tensions in the financial system. And ultimately what transpired was Janet Yellen came out and she said, well, there were a bunch of leveraged hedge funds who take 10-year treasury bonds and put a lot of leverage, sometimes 50 to 100 to 1, down on the table to try to make 25%. But when they unwind those positions and they have to sell bonds, that creates a lot of problem in the system. They didn't ask her why those hedge funds had that money, had those treasury bills in the treasury bonds in the first place. The reason is that the Federal Reserve and everyone else looks away from these highly leveraged positions from these shadow banks because they are the ones that are buying the bonds. 800 billion potentially tied up to these leveraged funds that are trying to do this basis trade. But in periods of this unwind, and when we have these, multiple sigma events, that is where these things can blow up. It's usually always the safe asset that causes the crash. In 2008, it was mortgages, which were supposed to be historically safe. In 2022, it was gilt bonds, again, government bonds, nearly blowing up the system because pensions had to dump it because the interest rates had risen, the value of the bonds had declined, but they had to raise cash. The same thing happens here. The 10-year bond is supposed to be the safest asset in the market. It is the risk-free it is the risk-free trade, and yet it is the asset that potentially sank the entire system in April. There are other stocks correlated to AIG, MetLife and Genworth and the insurance companies, student loan services like Navient and Sallie Mae, leveraged REITs like Annaly and New Residential, leveraged asset managers like Blackstone and Apollo, and regional banks like Zion and Comerica. All of these behave in a very similar fashion to what AIG does. So if you are looking to buy at the bottom and you're looking for something that might kick off a lot of cash and has upside because these are the things that are protected in the system, this is where the default risk really lies. These are the things to buy when all of those things line up. So what comes next? Where our false peace in the market seems to be ending, we anticipate the ongoing move to consumer defensives. We're looking for speculation in energy, currencies, and commodities. We are looking for the end of the cycle next year. That'll be a shift toward bonds and defensives. It's a great period for active trading. And when that bottom comes, and you hear that the Federal Reserve is now going to have to engage in QE in order to provide more capital to the system, buy everything that's not nailed down. Distressed credit, tech, cyclicals. Again, the purpose of the market is to reach the outcomes that we have seen. And so many times retail investors get caught because they hear the panic and they hear the horrible news. And the reality is that Tepper was right in 2010, that there is a Fed put. Because the system goes, you either print the money or you start a revolution, which is a great line from the film Money Game. You either print the money or you start a revolution. So this will continue for a foreseeable period, and it can last much longer than you can stay solvent trying to short it. Pay attention to these signals because you might be bearish in these conditions, yet we have high insider buying, policy changes, stronger momentum, and injections in liquidity. And if that's the case, close your shorts and go long. Focus on cyclicals and tech and distressed credit, and of course the SPY when that time comes. And that time will be coming. But right now, we are in the middle of this cycle that continues to ascend. We will continue to focus and see speculation on commodities. And again, be active and watch these signals. So in conclusion, every system is perfectly designed to get the results it gets. The world financial system is designed for perpetual bailouts, central bank for support for global liquidity, and a prevention of deflationary crisis. Mass insider buying tends to reflect market bottoms in these crises and accompanies major policy changes that offer a boost to liquidity. Equity strength signals provide a safe on-off switch. In addition to oversold readings on the RSI and MFI, they also have a history of foreshadowing crisis days on days or weeks before major liquidity events. And as I said, AIG benefits from the reduction in liquidity risk and policy bailouts. As I always say, stay positive. In this environment, it might feel like you're falling down a flight of stairs with nothing to grab onto. But this is a different view of the world. This is my view of the world, and it has been shaped by 17 years of academic work. It has been shaped by a constant focus every single day on momentum and trading. And once again, if you are looking to try to understand the best way to trade, the best way to be invested in the long term, we're here at the Capital Wave Report. We're here with the Substack and me and the Money Printer. We focus on this every single day. We talk about liquidity, momentum, and insider buying as tools, and we're always gearing up for that next big event. We have seen this happen so many times. Again, Four Sigma events going back to 2020, that we are kind of hunting for black swans at any given moment. But we also know when it is time to jump back into the pool, and we also know when to do it before everyone else does. We like to get out of the way before crisis hits, and we like to obviously take advantage of weakness and panic because, again, the markets are highly behavioral and these opportunities persist. We only need one or two of these a year for really significant returns. And we also are always looking for ways to kick off cash and generate significant amounts of income as we go. So our focus will remain, again, in commodities, the things that are aiming to hedge against continued monetary expansion and liquidity expansion in the future, things like gold, things like silver, but also the other things that kick off cash, right? MLPs, REITs, mortgage securities, things like that that are safe in this environment until they're not. And we know exactly when it is time to hedge or take gains from them. We also are going to continue to follow the sovereign wealth funds, the companies, or forgive me, the state-sponsored investment vehicles that are coming into the United States to invest in things like data REITs and AI data centers and pipelines, things that are going to kick off hard cash and go back to them, right? We want to take advantage of that because that is probably the most significant geopolitical event of this year and will be a dominant force in the future. And finally, it's always important to pay attention to the electricity market. Electricity is becoming an even more important commodity than ever. It is going to obviously be prioritized to the AI companies in America and the manufacturing elements of America and not to you. So it's important if you're worried about a higher electricity bill in the future, you're obviously going to want to pay attention to this and know exactly where you're going to be able to protect your wealth, adjust for that inflation, and sleep better in the evening. All right, that is the end of my presentation. As I always say, stay positive, continue to focus on momentum, continue to focus on the signals, and I hope that now that I have laid this out, this will forever be something that you will never be able to unsee. Have a great day. Thank you again for your time.